Jeff, what did we learn this week about oil and its expectations for Iran?
Well, first I want to say oil and commodities are still the best performing asset class despite this pullback here. We're still up 4% year to date and energy is up 11. I think there's three questions we need to ask about Iran. Obviously, one, what was priced in? What does the announcement today potentially mean? And then what does this mean to prices? First, in terms of what was priced in, a lot of people were talking about Iran going to zero by October. I don't think that was really what priced in. It's probably something closer to 800,000 to a million barrel per day level of Iranian exports. Now, our expectations were somewhere between 1.2 and 1.4, going to 1 by early next year. And that's when you look at the sell-off over the last week, most of that was demand. It was because it was, running in lockstep with what the equity market was doing. So yesterday was the first day we really priced in Iran. And how do we know that? It's because the back end of the curve came down. It wasn't the front end getting hit really hard like it was when the equity market was coming off. In fact, the way you like to say, Iran drove you up, but demand drove you down, but yesterday was different. Now, our expectations are you'll probably see something closer to a 50% reduction every 180 days, which is much more aggressive than what Obama had at 20% reductions every 180 days. Now, why are we bullish from here and think that the market is oversold? We're just now beginning to see the Iranian cuts begin to impact inventories. Inventories are beginning to tighten. Positioning in the market now is very light. And then the third reason is the overall demand picture still looks good. And then we'll probably talk about copper and the rest of the emerging markets.
Yeah.
That's likely to turn, all putting upward pressure.
So I want to pivot on the curve point that you made. If you come inside the Bloomberg, I'll illustrate it for you. So the blue line here is CCRV, by the way, in your terminal. The blue line here is where the curve was a week ago. The orange line is where we are now. So what Jeff is talking about basically is this re-rating here. So if you go to like 2020, for example, we were at, say, 73, and then now we're at 70. So that kind of re-rating all across the curve. So, Jeff, what part of that was also U.S. oil production in August, the top producer in the world, Russia nearing a record again, OPEC pumping the most since 2016? What part of it is the market believing there's enough oil to offset Iran, too?
Well, I think it's not so much issues about those types of increases. And the U.S. is August. That was a long time ago. And the other ones, we had expected very big increases from Saudi and Russia. I think the key point here is that people are less concerned about breaching capacity constraints. And that's why that back end. But it only came off about $1.50. So we're not talking about, a big increase. The other part of that picture is that front end came down. That's an indication of growth concerns and demand worries. That's the part that's likely to be repriced in coming weeks and months. And in particular, when we think about the inventories, we have those increases. What do we know in the high-frequency inventory data? Inventories are drawing, which tells you that those increases that we saw relative to the Iranian cuts were not enough to offset demand growth. And as a result, we're drawing inventories for the first time in about 3 months.
So when we flipped into contango for WTI like a few weeks ago, even though the spot prices were like on a tear, so the short-term prices are below longer-term prices, what did you make of that? Was that a correct read then of demand? And is that what we need to start factoring in the next few weeks or what?
Oh, yeah. When I look at the market, let's say about a week ago, we were sitting at $78 a barrel in contango. Being at 78 didn't surprise me. Our forecast this summer was for 82. But I thought we'd be in very steep backwardation, which is typical for a late cycle economic environment, which is what we're in. So the fact that front end across the board got into contango is not consistent with the inventories or where we are in the cycle, which is why we have our forecast of 80, is we think the front end's going to do that, and we're going to see spot prices rise relative to the back end.
So it seems to me that there are two things fighting with each other. One is geopolitics, things like Iranian sanctions on the one hand, and the other is global growth. Right. Things like trade with China. If you look at those two things, which is most likely to disrupt these numbers? That is to say, the numbers are different from what we thought they'd be.
I would say, in terms of thinking about actual losses, I wouldn't put it in either one of those. The concern was you had, outright, slowdowns, economic slowdowns in places like Brazil, Latin America, high oil prices, strong U.S. dollar. That was weakening demand. Was that weaker demand going to back up into the U.S., create weakness in product prices, and create much larger problems? The trade war, for all, that you're looking at the concrete numbers that tied to it, is not that big. Similarly, when we think about Iran, are we talking an 800,000 barrel per day level of Iranian exports or 1.2? These are, not that large.
Well, even if it's not because of trade, China is slowing down. The rate of growth is slowing down.
But they're stimulating.
Quite apart. They are stimulating, but can they stimulate enough to make it up, particularly when it comes to commodities, particularly oil and others?
Well, I think the key point there is spending on infrastructure. And I think part of that's what's going on with copper today is that when we look at the type of stimulus they're likely to do this time, they tried monetary policy earlier this year. It didn't work. They moved to infrastructure spending. That's going to be metal intensive.
So let's go to China for a second. If we do get some kind of an agreement or even a truce between China and the U.S., what's the upside for those exposed, like a soybeans, like a copper, aluminum, for example?
Well, you take nickel. It's massive. Right now you're trading, below 12,000. We think you can get as high as 18,000. Copper, you're up 2.5% today. These markets are outright short. You're trading 6,300 on copper. We think it can go to 6,500 and shortly all the way up to 7,000. And I think there's a lot of upside risk to those numbers because, again, these markets are short. And the other thing about commodities right now, which is why this is a pound the table, buy them right now, is that the positioning is incredibly light. Metals are outright short. Now energy is outright short. And when we look at the energy sector, you've gotten a lot of the length out of the market.
Okay, so how long can China keep that up? Because the fact is you can just build so many apartment buildings nobody's living in. And there's a limit to how much infrastructure you can build. When you're borrowing money, you're leveraging up. At some point, it's going to catch up with them. So is this a matter of a year, 5 years, 10 years?
Well, I think it's the type of investment that's different this time than it was before. It's more new economy oriented things like, light rail as opposed to building, bridges and roads. So it does have a different flavor to it. That eases some of the concerns. But I think when we think about it, further out, the question is, will they pursue deleveraging more broadly? And that's the bigger question that people are asking. Are they going to relax anti-pollution and deleveraging goals right now to further economic growth? And when we think about what's going on in the anti-pollution, there's really no evidence that what they're doing is that negative, just giving corporations bigger or opportunity to choose what they want to do. They still have to hit their targets.
So going back to sort of pounding the table by commodities now, do you have to distinguish them? Because why do you want to buy oil if it's in contango? Like copper, I get, okay, but why? So you have to distinguish which ones are going to...
Oil, I want to own oil. And the reason why is that I would argue that it was the CTA selling on the front end that pushed that front end. Fundamentally, inventories are still below the 5-year average. Demand is still relatively good. The Iranian barrels are coming off the market. The market's short. There's a host of reasons you still want to be long oil.
Okay, so if you have a more constructive view going forward, how do you own gold? And I know you are also constructive on gold for the next 3, 6, 12 months.
Well, gold, there's two drivers of gold. One is wealth creation in emerging markets. That has been on the back burner for quite some time. We think that China is going to re-enter this market and start buying gold with a better economic backdrop. Then we turn to the fear driver. A lot of concerns about recessionary probabilities rising in parts of like the U.S. and the other developed markets. That's also been supporting gold. In fact, I believe gold's the best performing of all the commodities over the last several weeks. But at this point right now, if you get a turn in the EM, that's really what drives the outlook for gold because it's wealth creation creates the demand for real physical gold.
So how can you own, though, oil and gold, making a similar case for both?
Well, we think about what the outlook for the non-energy space, it's much more EM oriented. The outlook for oil is more DM oriented. So we see a reconvergence of global growth. You'd argue you see a reconvergence of both of the outlook across the commodity complex. Where were we a year ago? As we went into year end, it was that global synchronous growth story.
Yes.
And that pushed both oil as well as copper and the rest of the complex higher, even gold. We think we'll see not as strong of a convergence there, but in fact, we saw it in the equity market the last couple of days. Is you're seeing a convergence between EM and DM, and you're seeing if you take WTI out, Brent is up today, copper is up today. That you're seeing that DM-EM reconvergence, which is the same thing as metal energy.
Quickly, do you need a weaker dollar for that story to play out?
It will help. I think we're seeing evidence of it right now.